Your offer letter says RSUs. Your friend at a startup says ESOPs. Both of you think you are getting company stock, but the way these two instruments actually work is completely different. And the tax hit, the risk, and the money you actually take home, all of that changes depending on which one you hold. Most engineers use the words ESOP and RSU interchangeably. That means they are probably not planning taxes correctly and maybe even making bad decisions when switching jobs. So let us break this down properly. What each one is, how the money flows, and where the tax hits. Let us start with ESOP. An employee stock option plan gives you the right, not the obligation, to buy company shares at a pre-decided price sometime in the future. That pre-decided price is called the exercise price. The company says after you complete your vesting period, you can buy our shares at this locked-in price, no matter what the market says. The catch? You have to pay that price out of your own pocket. And if the share price has fallen below your exercise price, you would not exercise at all. Now compare that with RSUs. A restricted stock unit is a promise from the company to give you shares for free once the vesting conditions are met. No exercise price, no out-of-pocket payment. You just wait, the shares vest, and they land in your demat account. Both ESOPs and RSUs have exactly two tax events in India. Section 17 subsection 2 of the Income Tax Act treats both as perquisites under salary. Tax event 1 happens when you get the shares, exercise date for ESOPs, vesting date for RSUs. Tax event 2 happens when you sell, that is capital gains, same for both. Now here is where it starts to matter. The perquisite, meaning the amount your employer adds to your salary for tax purposes, is calculated differently for each one. For ESOPs, the perquisite is the fair market value on the exercise date minus the exercise price you paid. For RSUs, the perquisite is the full fair market value on the vesting date because you paid nothing. Let us run a clean example. Say a company grants you 1,000 shares. The fair market value when the tax event happens is 500 rupees per share. And for the ESOP, the exercise price is 100 rupees per share. With the ESOP, your perquisite is 500 minus 100, which is 400 rupees per share. Multiply by 1,000 shares and your total perquisite is 4 lakh rupees. With the RSU, there is no exercise price. So the full 500 rupees per share is the perquisite. Multiply by 1,000 shares and the total perquisite is 5 lakh rupees. Now assume you are in the 30% tax bracket with 4% cess. On the ESOP, the perquisite tax is about 1,25,000 rupees. On the RSU, it is about 1,56,000 rupees. So the RSU triggers a higher perquisite tax. But remember, with the ESOP you also paid 1 lakh rupees out of pocket as the exercise price. So the total cash outflow at the time of getting those shares is actually higher for the ESOP. That is the first surprise. Even though the ESOP had a lower perquisite, the ESOP actually costs you more cash on the day you get the shares. Now let us fast forward to the sale. You sell all 1,000 shares at 700 rupees per share after holding for more than 12 months. For both ESOP and RSU, the cost of acquisition for capital gains is the fair market value on the day the perquisite was taxed, which is 500 rupees per share. So the capital gain is 700 minus 500, which is 200 rupees per share. Since these are listed shares held for more than 12 months, long-term capital gains tax applies at 12.5% on gains above 1,25,000 rupees. That works out to about 9,375 rupees for both. Now let us put the full picture together. Total tax on the ESOP across both events is about 1,34,000 rupees. Total tax on the RSU is about 1,65,000 rupees. So on paper, the ESOP pays less total tax. But it also requires you to spend 1 lakh rupees out of your own pocket to exercise. The RSU costs 0 to acquire. That is the core trade-off. Now let us talk about risk, because this is where the instruments really diverge. Imagine the company's share price falls to 80 rupees per share. If you hold an ESOP with an exercise price of 100 rupees, exercising would mean paying 100 rupees for something worth 80. You would never do that. your options are effectively worthless. But if you hold RSUs and the share drops to 80 rupees, you still get the shares for free. They are worth less than expected, but they are still worth 80,000 rupees for 1,000 shares. That is not zero. Let me show you how the value changes at different share prices. Assume the exercise price for the ESOP is 100 rupees and both grants are for 1,000 shares. Notice how the RSU line is always above the ESOP line. At higher prices the gap becomes a smaller fraction of total value. That is why ESOPs are called the higher risk higher reward instrument. There is another key difference that matters for startup engineers. If you are at an eligible startup certified under Section 80 IAC of the Income Tax Act, you can defer the perquisite tax on ESOPs for up to 48 months from the end of the assessment year. That deferral means you do not have to pay tax when you exercise. The tax only comes due when you sell the shares, leave the company, or the 48-month window expires, whichever happens first. This deferral is only available for ESOPs at eligible startups. RSUs do not get the same deferral treatment. So if you are at a small startup, ESOPs can actually have a cash flow advantage that RSUs cannot match. The honest answer is neither. It depends on three things. First, do you believe the share price will grow a lot from here? If yes, both give you upside, but ESOPs give you slightly more tax-efficient upside because of the lower perquisite. Second, can you afford to pay the exercise price? If the exercise cost is large, it locks up your cash. RSUs have zero acquisition cost, which means no cash pressure at all. Third, is the company public or private? If it is private, especially an unlisted startup, there may be no way to sell your ESOP shares to pay the perquisite tax. That creates a real cash trap unless the startup has Section 80 IAC certification. Here is a quick summary of when each one tends to work better for you. One more thing. Most engineers do not get to choose. The company decides which instrument to offer. But knowing the difference helps you evaluate offers. When someone says your CTC includes 10 lakh rupees of equity, ask, is that RSU or ESOP? What is the exercise price? What is the vesting schedule? Is the company listed? If this cleared up the confusion between RSU and ESOP for you, subscribe to WealthCode. We break down India personal finance the way engineers think, with numbers, examples, and no fluff. We are working on something that could change how you think about your salary structure. Hit subscribe so you do not miss it.